everyone. Thank you for joining us today. I am absolutely delighted to moderate this panel of very experienced professionals. And thank you for waiting for us. We ran a little bit late. So I'd like to start, please, by asking you to introduce yourself and your expertise. And what's your passion in this industry? What do you do? Like, why do you do it?
So thank you for having us. So for me, still till this day, the bread and butter is very much trading. I come from institutional background. I worked as a hedge fund trader for Bank of New York Mellon, equity trading with Bank of America. I've set up a desk for several different brokerage companies in terms of research, and we sell research. But till this day, the main thing that we do is still trading.
Hello, everyone. My name is Arthur. I'm CFO and founder of B2 Broker Group of companies. So basically, we run three types of businesses. It's a B2 broker, liquidity and technology provider for brokers. Then B2B in Pay, it's a cryptocurrency processing company for merchants and enterprise clients. And B2 Prime, it's a regulated, European regulated and Mauritius regulated prime of prime liquidity provider for institutional clients. Thank you.
Hello, checks. Yeah, thank you very much, Elena. Hi, everyone, ladies and gentlemen. My name is Firdaus. I'm a regional manager for Fullerton Markets. I've been trading since 2008. This has been my hobby at the same time, and I make my hobby as my career, and it has been like tremendous, more than 10 years now. So I'm delightful to be here, meeting you guys, and I hope that you enjoy this session. Thank you.
Thank you very much. So I hope you're as excited as I am now. And I think, well, looking at our broad topic, how to master the perfect FX strategy, of course, that's not easy. Otherwise, we won't be sitting here. Now, Firdaus, I will go to you first with your trading experience. And of course, there are lots of, I don't mean to sound plain, but there are a lot of rules. We hear every day, trade is your friend, and so on, so on, so on. But what, in your opinion, are the most essential rules of trading?
Yeah, of course. When we are talking about trading, you cannot tolerate or you cannot deny that one of the factor in trading is losses. We cannot avoid, and you have to accept that losses, right? However, in order to success in this trading, you have to minimize and reduce the losses. That is what comes the good trading strategy. For me, by my personal, there would be three elements in a good trading strategy. Number one, the 20%, if you have to learn about the technical analysis, fundamental and the sentimental, right? Number two is you have to manage your money and risk management. You cannot be like trading like crazy people, you know. You don't know what you are doing in the market. You are trading a big lot size in the market when you don't have enough capital in your account. And that is 40%, I would say. Another 40% is about psychological, right? You have to be ready in terms of your emotion and your psychology, because most of the traders, they are failed 80% of this trading strategy, and then they are making losses. They cannot mitigate all these risks. Yeah, so there's no holy grail technique or trading strategy in this world, basically, right? So you have to make sure that when you plan for your trading strategies, you have to make sure that your objective is clear. You have to minimize your loss and maximize your profit, right? So when you have this objective, I'm really, really sure that you can really, really be a successful trader in the future.
Thank you. So, Firdaus, of course, you have mentioned two words we hear a lot, technical fundamental analysis. Now, Naeem, in your opinion, and I know it's a bit of a holy wars here, but Let's hope we'll not get too aggressive. But Naim, in your opinion, what's more important, technical or fundamental?
Okay, thank you. So I think, look, if you are interested in day trading, what matters the most is the price action. Tesla isn't going to increase the production of their cars by 10,000, 1 million, whatever the number, in one day. Tesla will increase its production of cars over the period of times. That will impact their margins, their profitability, and of course, not to mention the most important one, geopolitical conditions. In a day, this is not going to happen. So if you are an investor who understands what the fundamentals are and you have a long-term horizon, I think fundamentals are great. But if you are just there to make few takes here and there, then technical analysis is very, very important for you because it's driven by price. But within technical analysis, there are so many different things that we discussed yesterday on our panel at 11 a.m. It's not about RSI has dropped over here, you go trading, you do this and you do that. That's not it. And I can tell you from my own personal experience, I do not engage myself in any sort of a technical trading unless I have done the back testing on that. And then I'm not referring to the normal back testing. I'm talking about you have a data for it, because if you just back test a certain strategy over 12 months, I can guarantee you any indicator can fit that. And then that will be, you'll be digging your graves yourselves. It is about you test your strategy, for example, over a period of a year for 6 months, and then still in the back that period, you'd see if that particular strategy has worked over the next 6 months, still the time has lapsed. If it works, then you move. But applying statistical analysis is the most critical, and it varies so much from instrument to instrument. I think these are the most important things.
Would you say it also depends on the asset class?
It depends on the asset class, of course, because if you are trading Forex, you got to know your economic calendar. That's where the fundamentals comes back in. You don't want it to have a position and then you have a retail data coming out, you have a consumer spending data coming out, central bankers are speaking. So this is why it is important. And I seriously say to you guys, this is not a 30-minute job. This needs hard work. It needs discipline, as he said. Because you could have a 1% loss every day. You can say that, okay, my risk management is a 1%. But trust me, we all have been there. Losing 1% a day, in 10 days in a row, means 10% of the capital is gone. To overcome that stress, that psychological element, it takes guts to still remain disciplined.
Spot on. Well, my background is technology. So we do technology for brokers, right? So we see all of you guys. We have an overview on how the brokers run their books, how are the traders trading. And we see very often that there are two types of behavior, right? So sometimes traders would trade the market using fundamental and technical analysis. But you can also see traders that are trying to trade the abnormalities. And there is one more person on this panel who works a lot in B2B field and sees a lot of brokers. So Arthur, in your opinion, do you see more traders trading the abnormalities or the market? And what do you think is more profitable? Like, what would be your strategy?
Thank you, Elena. It's a very good question, actually. And I think we see more or less the same that what you see, actually. But before I reply to that question, please allow me to give one golden rule. So the golden rule is before you go for the trading, you have to be honest with you, and you have to define yourself first. Who you really are. Are you trader or are you investor? Because it's completely two different definitions. And this is two different approaches, how you are going to deal with all of that, with all the capital markets. If you are a trader, you have to follow certain strategies and certain rules. And the rules are very, very simple. As Naim said, and my colleague from Fullerton Markets, yes. So that's why if you are an investor, you have to build your portfolio strategy, right? And it's completely different approach. It's about risk management, it's about diversification, it's about sectors, and it's about asset classes, and about long-term vision. So it's completely two different approaches. Now, about, Elaine, your question. So first of all, of course, we see a lot of spikes during the abnormal markets conditions. And
we talked about that yesterday a lot, right?
Like, yeah, it's always during the news, and especially important news, we always see the spikes, and all the systems, they get overloaded. And that's why at that moment, the many traders, they try to get into the market because sometimes, obviously, you know where price is heading to, and if you are able to catch this just 2-3 second trade, of course, most of the time you are going to be profitable. But the problem is that everyone is doing the same. And that's why when the liquidity providers received all that numbers of trades, obviously all those trades, they are making huge impact on the order book, on the market, and all these traders, they sweep the book. That's why it's so-called slippage definition. In reality, it's not a slippage, it's a market impact. So that's why, yeah, Elena, answering to your question, abnormal, how they are profitable, I cannot tell you because, you know, I don't do so personally, I don't do trades, but I see that the spikes in terms of the volume increase at that abnormal trading conditions.
How many people are actually trading on news sitting over here? Can you raise your hands, please, just to show that you're trying to make profit? And then how many are actually successfully making profit by trading news?
Wendy had 4. So, but yeah, coming back to sweeping, I think what's important, just to provide some context here, I think we're the only market in the world where when you buy more, you have to pay more. Because if you want to buy something else, if you buy more, you have to pay less. In this market, the more volume you want to get executed or filled, the more markup you have to pay. So, Naim, so a really good point. So do you think it's actually a sustainable strategy to be trading the abnormalities? Or do you believe it has to be like a consistent strategy of day trading?
That's an excellent question. And then I think this is why I want our audience to really understand. A lot of educators out there, they will have a strategies. Go trade the news. Let's trade the US non-farm payroll. And then honestly, trading US non-farm payroll, trading central banks meetings, trading the data is one of the most difficult elements. Broker is against you. And I don't mean the broker is against you in a way that they are taking the positions against you. I am saying the liquidity, what he said, is not going to be there. They're going to increase the spreads dramatically. So you have one major odd sitting against you. Secondly, any of the central banks, even though they've increased the interest rate, they could throw a dovish comment. And you could say, oh God, that came exactly how I wanted, but it didn't. So that's why wait because there's no rush. Honestly, one of the things that I tell myself till this day, don't worry about the losing an opportunity. Worry about the capital that you have. If you have a capital, you can go and then you can take a leverage on next time when you have it. Guess what? You will have only more experience from what you have learned today by missing that particular opportunity. But if you go and trade that, you're going to have no capital when you know, oh God, I know exactly what to do, but I have no capital to trade. So trading the news is only for sophisticated traders, or unless you're in the market for a long period of time.
Thank you. I think we're touching upon from the perspective of how much capital do you have, how much is the capital at risk, what's your drawdown, right? So I think we're touching upon the risk management, right?
Yeah.
So of trading. So what are your most important risk management rules? Like, I don't know, stop loss, take profit ratio, what is it?
Yeah. So again, this goes back to what we've just literally touched on. The 1% rule is a great way to begin with, okay? But risk management has a lot to do with your mentality of how you manage the trade. And I'm really telling you from my own personal experience over here, because there will be days you will lose 1%. There will be days when you will actually sit and you won't make the trade, but the trade will work in your favor, okay? And that's going to mess up your psychology in terms of that. Risk management for me is not losing the discipline. Forget about buying low and selling high or finding the exact entry into that. I tell you that the biggest fool in trading is trying to find the exact bottom or trying to find the exact low point. Because if you're going to continue to fish that, the odds are very much going to be stacked against you. It is about every week, and a lot of these traders, I can almost guarantee that 70% public sitting over here won't do it. And that comes from an experience of 15 years being in the industry. You do not study your trades at the end of the week. The biggest lesson that anyone can teach you is you by studying your own trades. That will help you to refine and define your strategy and your risk management. But before you go, you got to have what your risk is, what and how much you want to go for. Win ratio doesn't matter that much. It is what's your risk management in that.
So we're coming back to the, I think, psychological aspect of it. But I think there are a lot of, I know that there is not always a psychology there, right? So we see for the past year, we've been seeing the increase in algo trading, AI trading, and machine learning. And I think, Arthur, as a liquidity provider, do you see that increase as well? Is it a different type of flow? Is it more profitable for traders? What's your opinion on that? What's your take?
Basically, what we see recently, some changes in the market, especially I think for the last 1.5 years, that copy trading solutions have been kind of deeply integrated within all the brokers, and many masters, traders actually, what basically they do, they create a lot of trading master accounts. They connect to that to those trading master account different strategies, because basically you can find a lot of signal providers, a lot of even MQL signals, and you can build any kind of strategies based on several strategies. And then what is happening? As soon as all those masters create their trading accounts based on those algorithmic strategies, this is the most important, that all of them are algorithmic, because you cannot do this by your hand, it's impossible. You have to eat, you have to sleep, you have to spend time with your family, and the only robot can do so, right? Without any rest. And then all the investors or so-called followers, they subscribe to all those master accounts. That's where all these things begin. Because when the robot basically place the order, then thousands and thousands followers, they immediately replicate this order on the market. And that's where we see also the spikes. So that's why, Elena, answering to your question, I would say that 75% it's algorithmic trading. Besides also, which is also very important, you have to divide algorithmic traders and HFT traders, because the normal algorithmic traders, they still to try to use different strategies by using algo. When HFT traders, they try to find exploits within the brokers. It's completely two different things and two different approaches. Don't mix it up, one algo traders with another algo traders. It's two different type of traders. The first one, they are traders. The second one, they are not traders. It's kind of hackers in a trading business. They try to find the exploit. That's why when many brokers just begin their operations, the many such kind of traders, they come to the new brokers and they try to kind of abuse the trading system. And that's they are making the huge impact on overall the conditions.
That's a very good point. So there are indeed traders, and I guess that affects a little bit all of you. So very often, these people would try to abuse the good trading conditions that are given to you by your brokers. So swap free, for example, and things like that. And that's why sometimes brokers might be a bit less inclined to providing people with those trading conditions because they're so afraid of finding those abuses. And that's again about trading the abnormalities. But Arthur, just out of curiosity, and it just popped into my mind, I wonder if if traders often become your clients as brokers. Is there a lot of traders who end up opening their own brokerage firm and coming to you? Or obviously you're here, so I'm guessing they are, right?
I would say that not the traders, but the most of the brokers, it's ex-employees of the brokers and IBs. Basically, when IB created his network and he has sufficient numbers of his client base, then usually he starts thinking about to launch his own brokerage. That's why, if you can see, guys, many brokers, they have kind of, they call it institutional arm. That's the arm that are handling such cases. They don't want to let IBs just go away to the technology provider and to run their brokerage. It's better for them to share to give them infrastructure of the broker because it's already being built, and to work with IBs in a different level to kind of become partners. So that's the the cases.
Okay. So Firdas, coming back to you and coming back to the topic of manual versus robotic trading, what do you see at Fullerton, and in your opinion, what's more profitable based on your statistics or your knowledge or your background?
Yeah, well, it's a very tricky question, basically, because for us, we can see both manual and robot or AI tradings are both profitable, basically. But if you are really following a good trading strategy, because in AI, and basically the AI is more intelligent right now, because they can choose between several strategies and make your trading profitable, right? So for EAs or robots, they are more disciplined. Because in trading, the most hardest part basically is to control your psychology and emotion, right? So these robots will help you to minimize the emotional or psychological part, you know? So when robots are trading for you, right, you are able to at least manage the 80% of the trading strategy. Basically, all the trading technical analysis, whatever that you have been learning, you already put there in the EAs or the robots, right? The only 80% that you have to manage is your emotion and psychology. That robot will help you to do that. Because you don't have to stay overnight, you know, to stay for the FOMC, for example. You don't have to stay overnight just to pick up the spike or the trades during the central bank's news release, for example. The robots will do that for you. Or even the robots has intelligence to actually close or shut down your trades during big impact news coming, right? So basically, if I would like to compare, if I had a chance to really give a between manual and trading with a good strategy, I think robot is a winner because they are able to help you manage the 80% of that psychological risk management, money management part. Yeah.
Thank you. And I think that's why 70% of all traded volume is robotic. Now, do we have anything to add to that, or should we take some questions?
I'll just add very quickly.
Yes, please. I could see you wanted to.
Thank you. Look, I think if someone is telling you that, you know what, take a larger position on any particular instrument. Like I think earlier in one of the panels, I was just listening to this one and then say, oh, just increase your position all of a sudden. That is a recipe for a disaster, really. You don't want to do that. When it comes to algorithmic trading, and we all know how Citadel makes money because they are the market makers, and then they are great in doing that. As a retail investor, using AI, robots or bots, whatever it is, I think is not the best way to move forward. You have to have your own plan in place. If you are buying a black box, it is entirely just a black box. You've got no idea what you are trading in or what you are trading against in. Just to very quickly summarize, have your risk management as the most important part of that, and then make sure you review your trades at the end of each week.
Thank you.
Elena, just small also, I would support Naeem here because, guys, if you follow some strategies, regardless of who is it, and regardless of, doesn't matter how successful and profitable this strategy, do not allocate more than 5% of your capital to one of those strategies. Basically, it's better to be connected to 20 different strategies. That's the part of the diversification of the flow. Because today the strategy works, but tomorrow is not going to work. It's the always psychological circle and every single strategy. Because look, if you take a look deeply on the market, let's say martingale strategy, it has been implemented 20, 30, 40 years ago.
Yet it's successful
and it
again.
still works. And 50% of the strategies out there based on martingale. So that's why how you can trust that strategies.
Well, I think in the current market, I mean, let's not go into details on that, but I think in the current market, it's worth looking at. Our time is up. We'll take 3 questions for each of the panelists, and each of the panelists can choose who he wants to take a question from. So let's play a game. Please, who would like to ask a question? Just raise your hand so we can see. Who wants to take the gentleman here? Please. They will bring a microphone to you. The guy is coming.
Hi, gents. Oh, sorry. So, there's a big saying that they say 90% of the people lose 90% of their account in 90 days. So, what they doing wrong, and what about the rest 10% they doing right?
What I will tell you, I'm going to answer your question from a slightly different angle, okay? When I was working for someone else, like an institutional bank, there was an accountability. I do mistake, I get fired, or I got called up in front of my managers. There is no room for me not to follow the rules of what I'm doing. This particular market, I wanted to say you guys one thing. Yes, we have talked about all that this is not a 30-second or 30-minute game, but it is possible. I cannot give you more example. My own brother, who has no background in trading, honestly, he's done business and he's an entrepreneur for his entire life, is making 4% a month, which is very reasonable. When he started, it was during the COVID period. And I said to him, don't do it because I think you're going to lose money. The market is in a completely different territory. But you know what? What he told me, I said, do it. And this goes back to our conversation yesterday. He has more knowledge than most of the doctors have about diseases. He went against a specific industry, which is diagnostics, genes, DNA therapy. He understood that, and he went after only that particular sector and that particular sector only, and he is still successful. 3 years have lapsed. He is still successful. You all can make it. If I can make it, he can make it, you can make it as well. But do not believe if someone tells you, I get 10%, I produce 10%, walk away. If someone tells you 10% or anything like that, walk away. Seriously. That is, someone is trying to sell the shop and then they're getting actual payment from somewhere else.
It's all about commitment, isn't it? It's commitment and
100%.
hard work. It's not
And you know,
a
someone
lottery
said it.
ticket.
Someone said it earlier. They said, do not give up. The moment you lose when you give up. I guarantee you that.
Thank you. That was a really good question. Any more questions? Oh, yeah. Gentleman over there. Could you please? Yeah.
I think you quite didn't get my question, to be honest.
Sorry, what's the problem?
No, the question is like what they're saying that say 90% of the people lose 90% of their account in 90 days. What it makes them to lose that money? And what about the rest 10% of the people who make money like you, gents? What's the difference between that 9% who lose money in the market and what about the 10%?
It's not about running the market. It's not about running the market. If that's what you're referring to, it's not about running the market. The 10% or whatever the percentage that you're going for, and if I understood your question...
No. Not 10% of the money you make, but what about the 10% of the people who make money in the market? They're making money while the 90% of the people losing the money in the market. What's the difference between this 90% and 10%?
Discipline.
Is that it?
I think
100%.
if you look at any industry out there, there are 10% of people that are successful in it and they're doing great and they're committed and they're disciplined. And there are people who are just doing their day job and they're hoping for something. You are either committed and you make it work and you believe in it and you invest a lot of effort into it, or you just give up and leave it, you know?
You know, on one street, you could have 10 restaurants. Only 2 would be the most busiest
Precisely.
one. That's the answer to your question.
Can I add on top of that?
Yeah,
I think first of all, the new traders, as soon as they arrive on the market and they start trading, first of all, most of them, they start trading with a very insufficient amount. Let's say $100, $50, $500. And basically for them to lose that money, it's nothing. So it doesn't matter for them to lose money here or to go to buy coffee, because a cup of coffee now costs like $10, right? So it's $100, it's 10 cups of coffee. So basically when they start trading, psychologically, they consider market because it's not their day-to-day work. It's not their real income. So, and they consider market as a playground. You know,
exactly.
they consider market that, okay, they came here just to try. And that behavior leads to the losing money. Because in that case, you do not follow any kind of strategies. You just play. That's it. That's why many newcomers, they initially when they come, they lose the money. But as soon as they consider market as their single and main revenue for their life, for their family, that's where they start thinking differently, and they consider market as their job. So that's, you remember the golden rule. You have to define who you really are. If you have a job and you are, I don't know, you work 12, 10 hours a day on your other work, and then you come home and in the evening you decide to trade, you are not a trader, you are an investor, because it's not your main income. In that case, you have to follow another strategies and be investor. But if you wake up and in front of you 3, 4, 5, 6 screens, and you read all the market news, and you really think that you are a trader and your income is depending on your profitability, that's where you start thinking differently.
Please. Hope that answers your question. Yes, go ahead. Did you get the microphone? No? Okay, can we have one last question, please? Because I promised. And then can you please give microphone to that gentleman?
All right, everyone, we'll take one more last question.
Yes.
Quick question, though, because we've run out of time.
We have a gentleman in that white cap, please, because we already promised him. No. At the end of the...
At the end, back there.
Thank you. Thank you very much.
Thank you very much. My question goes to Arthur. You said you are never a trader and you've never traded. So what's the assurance that your company provides the best or provides the suitable profits to your customers, because you don't know how it feels to trade and lose? You've never traded. So what's the assurance of your company to your customers that they will make profits, because you've never traded?
Okay, I think it's a bit kind of misunderstanding. We never assure anyone, because we provide technology and we provide infrastructure for the brokers. For us, to be honest, it doesn't matter where market is heading to. Is it upside or downside market? Our company is a liquidity provider. So liquidity provider is making money on the commissions. And the commissions is generating by the brokers when there is the volatility, when there is any kind of market news. That's where the brokers, they are sending flow to the liquidity providers. And brokers, they are getting flow when the traders is making their trades. And again, those trades depends on the strategies and market volatility. So that's why we, as a liquidity provider, we never guarantee anything. But what we can only guarantee is that we provide to you as a broker, sophisticating trading infrastructure, that you have a very reliable fixed API connection, that your liquidity will not be interrupted every single, 15 minutes, and even during the very high load events, you will still will have the connectivity, and not just connectivity, but ultra low connectivity connection. So that's actually what we basically take care of, and then the brokers, they take care of the traders.
So to answer your question, Arthur doesn't need to trade. He just needs to provide ultra-low latency infrastructure to the brokers so that you can trade. Thank you very much. Apologies that we've stayed a bit longer than we were supposed to. Thank you. Please applause the amazing panelists.
Thank you very much, guys.
Thank you.
Have a profitable
Thank you.
trading. Thank you. Bye-bye.
Thank you.